Thank you all very much indeed for coming to this lunch. It's great to see so many people that we have met and to meet new people who do not know about Aquis. My name's Alasdair Haynes. I'm the founder and chief executive of Aquis Exchange. I've been in the industry for 40 years. And I have every intention of trying to be in the industry for another 40 years. I certainly can't guarantee that. I'm here with Jonathan Clelland. Jonathan.
I started at the business with Alasdair. I am the CFO and COO, and previously worked as the COO of HSBC Corporate Finance, and then at Shearman Sterling, which is an American corporate law firm.
Okay. Well, look, we're here obviously to update you with the interim results. But before we go through the results, which we're very pleased with, I'd just like to sort of just go back a little bit and talk about Aquis Exchange and what we do and what differentiates us. Obviously, the holding company is Aquis Exchange PLC, and you can see on slide 3 the triangle here. Today, we operate really two businesses, the exchange business and the software sales and the technology business of exchange software. Firstly, the exchange business. What differentiates us? Why do people want to come to us when there are other exchanges out there? And fundamentally, there are two things that we do that are completely different to any other exchange you'll find. And the first one is we operate the subscription model. And as I think I mentioned last time to you, the subscription model is changing human behavior and changes the economies of over the last 20 years. The most successful companies we've seen through Netflix, Spotify, in your daily lives, you will have seen these incredible growth companies. And of course, the marginal cost of zero is extremely attractive. And one of the reasons we actually established the subscription model within the exchange industry is we have seen very, very poor liquidity in Europe compared to the United States over the last 20, 30 years. In fact, we do a quarter of the trading in Europe than that is the turnover of the turnover of the United States, which is quite remarkable considering the population of Europe is actually slightly larger. The land mass is actually slightly larger. And over the last 20 years, the GDPs have been pretty comparable. So if you're looking at ways of which you can try and enhance liquidity and enhance turnover, there isn't a better way than the subscription model, because the number of phone calls made today, the number of phone contracts actually is 8.2 billion, more than the population of the world. The amount of television that's watched through subscription, greater than it's ever been before. The number of movies that are manufactured and made because of subscription. The amount of music that's listened to. The amount of shopping that is done through retail like Amazon Prime has changed, again, all because of the subscription model. So the rationale here is we want to increase the liquidity of markets across Europe, and we're going to do it by a different model. The second thing that differentiates us is the fact that we had an experience, and I think I discussed this last time, of proprietary trading and various types of proprietary trading strategies that can have an impact on liquidity. And we made a very bold decision back in February 2016, which is we banned proprietary traders. We brought in a rule that prevented proprietary traders from crossing the spread on the exchange. And what that simply means is proprietary traders can become members. In fact, we have many that are, but they have to use a special order type called the post-only order type. And that means they can only supply liquidity. They can only be on the bid or on the offer. And if at the time they put a bid or an offer in, the market price moves, their order, instead of crossing the spread, would get rejected. So we know for a fact that 100% of the time, proprietary trading firms that trade on Aquis are suppliers of liquidity and not takers of liquidity. And that has actually changed the profile of liquidity in the platform. What this has done, this rule, it has made the toxicity, or what we call toxicity, on the liquidity or in the liquidity within Aquis very different to our competitors. And you can see this is actually the UK market, but it is referring to millions of trades. And what we're doing is on the x-axis is time, and we're looking at what happens to price immediately after a trade takes place. And we're talking here not about transaction cost analysis, which might take an hour, a day, a week to look at. We're looking here at 50 milliseconds right the way out to 5 minutes. And what you can see here is the percentage time the market moves against you, which is the yellow, the blue, and the grey lines, and the orange lines, which are the stock exchange, Chi-X, Turquoise, and BATS books. You can see within 50 milliseconds how those prices move, which will explain to all of you who've traded that when you try and buy stock, very, very quickly, the stock price moves against you. In fact, in many cases, this is showing you like 100 times faster than you can blink. So you don't even see this, the prices are moving, and that frustrates traders and actually adds enormously to the implicit costs of trading. If you want to reduce the implicit costs of trading, you can see the profile of Aquis, which is the blue line at the bottom. And you can see how different that profile is to every other market that's out there. So much so that if prices don't move, as they don't on Aquis, your implicit costs can actually save, we've calculated in the industry, over £1 billion a year. That is 1 week's pension for every private pensioner there is in the country. These are not insubstantial amounts of money. And that is purely based on where you decide to trade. That is not which stocks you decide to trade, but where you decide to trade. So those two things, a subscription with a marginal cost of zero that's proven to enhance liquidity in other industries, and the rule that actually has banned a particular type of trading that allows for a different type of liquidity, which is more beneficial to the end investor, is the fundamental difference that makes Aquis the story that it has been today. We'll come on to what that has done and show you sort of market share growth, etc. The second business that we have is a software business. And Jonathan will explain some of that later on, but we have a very successful licensing business. It works on a SaaS model and also a licensing model where people will take exchange technology, and as we have built something that we think is very special and very efficient, has become a serious revenue source for our business. Now, of course, many of you will know that we've also announced the deal to buy NEX Exchange. And this triangle will change. And very shortly, once that deal is completed, and we're hoping that completion will come through once we've got change of control approval from the FCA, which we think will happen over the next, the end of the autumn, beginning of winter time. We will obviously have a third strand, and that will be NEX Exchange, which we will change to the Aquis Stock Exchange. And we will then have that revenue stream from listings and growing the business and how we'll monetize. And I'll talk about that later on. Of course, you may also hear all the different acronyms. Under the exchange, we operate an MTF, a multilateral trading facility. We have a Brexit strategy, so we operate one in London, and now we operate one in Paris, in which case we've got a license for. And then you'll hear all this type of technology you may read about or hear about and look on our website, Aquis Matching Engine, the surveillance products, the Aquis Market Gateway. And these are all the products that we have that come under our business divisions. So let's go back to the results and our first set of interim results for this year. This is undoubtedly, we think, a strong first half. We grew our revenues by 165%. And I think what's important is you need to see the backdrop here is a turnover decline in the industry for the first 6 months of 16%. So we're growing revenues in what I think is an incredibly difficult time. And I think everybody knows financial services, in fact, the economy as a whole, is suffering because of things like Brexit, because of trade wars, etc., that's going on out there. Brexit. It's taken me a few minutes before I've had to mention that word, but clearly, you have to cover Brexit. We think we are fully covered in every way that we can be today on what the various outcomes of Brexit. And it is remarkable that we're sitting here today and we are only weeks away from when the government is telling us that we are leaving Europe, deal or no deal. And in truth, we still do not know whether we're going to have share trading obligations, whether business is going to be restricted from Europeans can't trade in the UK, UK can't trade in Europe, or UK, it's just a muddle today. And therefore, for companies like us, we've had to prepare in every way our technology so that wherever you are, if you're EU27 and have to trade in EU27, you can. If you're EU27 and you're forced to trade somewhere else in the UK, then you can, and vice versa. So we think we've covered every angle that is necessary. We've adapted and changed our technology in order that we can actually do this. And that's actually a harder task to do than sounds. But we are fully compliant and ready. In fact, so much so, we have 12 live stocks trading in Europe already today as test stocks for people, but they are in a production environment, and anybody, in fact, all our customers have tested. Turn over to the next slide. We've grown our clients. We've grown from 27 clients to 29. Now, that might not sound a huge amount, but again, I will put the mitigating circumstances there, which is, of course, we've actually had to introduce and add every single one of our current clients into their EU27 entity. So actually, we've added around 26 clients during the first 6 months, because if you think a bank is based in London, we'll also now have an office in one of the jurisdictions in the EU27, and they too have to connect to you. So you have to go through all the legal, you have to go through all the compliance, you have to go through all the connectivity, and that takes up a huge amount of their time as well as our time. And I think we cautioned investors and said, while Brexit is here, whilst everybody's having to change, it will be incredibly difficult to grow new members, because simply most of these banks and brokers do not have the resource to add anything new, and they have to get ready for Brexit. So I think, if Brexit is delayed, this problem continues. If Brexit is finished and we've done something on the 1st of November, then I think we're in a position to start growing again and see more momentum from the growth of clients. So you don't need to be too smart to realize that our growth in revenue of 165% obviously did not come from new members. It has come from walking people up the subscriptions. And that actually is an incredibly encouraging sign, because what it means is if somebody likes the product, they use it more, they're happy to pay more. And we've certainly done that. And I think if you can do that in a background of very, very difficult circumstances, it shows that we've got something absolutely right with this model. So I think we're very, very encouraged with what we've seen from these results. And again, the second point that proves that is that we've grown our average market share of continuous trading in European equities from the fourth quarter 2018, which was 3.8%, a whole percent, to the second quarter of 2019 at 4.8%. And I reiterate, for those of you who heard the last talk during the last set of results, that once you've hit that 4.85%, it is incredibly difficult to comply by best execution and not be a member of Aquis. In fact, it sort of becomes embarrassing for somebody. Now, the focus from the regulator today is very clearly on Brexit and not actually forcing people on best execution. But we predict that that will change. When Brexit is behind us, then obviously the regulators will focus on MiFID II. They will focus on the all-sufficient steps necessary for best execution. And if you have a market share of around 5%, across the whole market, which means quite often we might be 10, 15% in particular stocks, it is very, very hard to justify if you are a bank or broker today that is not actually connected and using Aquis. And to strengthen that even more, we actually have grown the amount of available liquidity. Now, again, if you remember from last time, the way we describe that is the actual liquidity available at the best price, and what percentage of the total liquidity, which you would have to do if you were going to comply with best execution and trade and cross the spread. We own 20% of that today. And I would ask you just to flick to the very back page. There's an appendix slide there, which shows this, I think, as a very, very compelling argument as to why we will grow market share. And this graph here shows all the major indices across Europe, the top index. It shows all the data for 6 months. So this is H1 2019. And the bar graph shows you the actual market share that a venue has attained. So if you look at the grey bars, which is clearly larger than any of the others, that is actually the Chi-X book, the CXE book. The lines going across are the lines which actually refer to the actual percentage of liquidity that they have. So you can see in the case of Chi-X, the grey line more or less touches the top of the bars of their actual market share. And you would expect that if you have a 20-25% share of actual liquidity at the best prices, you would actually attain a 20-25% market share. You could look at the red line, which is turquoise. It more or less touches the bars. There they have a sort of 4-5% market share, and you can see they actually have that amount of liquidity available. If you look at the blue line, which is Aquis, our actual available liquidity is equal to that of the Chi-X book. And yet today our market share, which are the blue bar chart, you can see clearly doesn't. And that tells you that there are not enough members who have joined Aquis yet, and there are not enough people using this correctly. And over time, you have got to be pretty certain that the bars will grow to where your actual market share is. So when investors ask us on a regular basis, do you think you can get to 10% market share? Because that seems to be a number that people want to hear. You should look at that chart with enormous confidence and say, you are incredibly confident of breaking through that 10% market share level. So it is a key metric for us to look at how much actual market share of liquidity we have today, because ultimately that drives what our market share will be. If we look at it in slide 6 and you look at the actual growth, what you can see here is a nice steady line. You can see from June 2018 when we IPO'd and we were just around the 2% mark, we hit the 3% target that we expected and wanted to do by the end of the year, by August, September. We've gone straight through that. Towards the end of the year, we were 4%, and we're now touching towards the 5% mark. In fact, yesterday, we were over 5% for about the 4th or 5th time. Now, we'll always warn people that market share is not a straight line. And I'll give you one very good reason, which is at quiet times or at volatile times, you will get proprietary trading firms that will actually want to trade, but actually asset managers and retail investors who don't want to because they feel the markets are too risky. Now, as we've said before, if we don't have proprietary traders and their aggressive trading, and that is what the majority of the market is doing, and then you would expect our market share to decline at those times. So do not expect to see a straight line. Although I can say at this very point in time, our current market share for the month of September is at 4.85, I think, as I looked at it this morning, and that is still a record. So while it's nice to see this line continue and going in the right level, the right ways, it doesn't always go in a straight line. The important thing to watch is what is that trend line? And the trend line here, I think, is very, very clear from June as to the progress that we're making. So that is... As I said, I think we internally are very encouraged by what we've seen and very encouraged by the performance in the first 6 months and believe that we've got a lot of opportunity lying in front of us. At this point, I shall now pass over to Jonathan, who's obviously the CFO, to go through some of the financial numbers.
So, as Alasdair mentioned previously, headline revenue growth for the comparable period of 165%. So revenue 3.4 million in comparison to 1.3 million in the previous period. Of that, substantial revenue growth for the exchange as members increase their subscriptions, and also substantial revenue growth on the licensing. Now, the licensing, we now account for licensing on the basis of adopting IFRS 15 and IFRS 9. IFRS 15 says that if you sign a technology contract, then you have to recognize the majority of the revenue, not 100%, but certainly a significant majority of it, at the point of time that the delivery. So when the customer accepts the technology delivery, that's the point of time. Even though it might be a 2 or 3 year contract, you reserve a little because you've got ongoing obligations, but that would be something like 5% of the value of the contract per annum. And therefore, a lot of it is recognized at the point of, effectively, point of sale. Now, we have a variety of clients. We have some very mature investment banks, and therefore would be very confident that they would, the performance would mean that they would be able to honor the contract. But we also have some startups. We have found in our delivery that our technology, the flexibility and the adaptability appeals to startups. And we have a similar ethos and culture to them in having built the business from scratch in the last few years. And as a result of that, we are, for example, delivering a technology contract to a startup who is specializing in reinsurance, another one who is starting with bonds and infrastructure. And as you all well know, with startups, it's not guaranteed that all of them will be successful. And therefore, to be prudent, we may reserve some of that, and that is adopted under IFRS 9. And then as the contract matures and they're able to continue to honour their financial obligations, so you may see a provision release. And what you'll see in the line below is that for the 6 months of 2018, there was a provision release of 295,000, and for the first 6 months of this year, 120,000. And that will continue as we work with a wide variety of clients. You'll see that that there will be provisions set against contracts, and then as they continue to prosper, we'll have some releases. On the expense side, we increased our expenses by 21%, and that's primarily as a result of investment in people and technology as we continue to grow our business. But the net result was that we had an EBITDA loss of 161,000 and a loss after tax of 621,000. So we are very much moving towards break even, and the analysts think that we should be able to achieve profitability next year. And that is certainly still a major target. On the balance sheet side, we have a regulatory capital requirement of 2.1 million, excess regulatory capital of approximately 11 million, and 11 million of cash or cash equivalents. So a very strong balance sheet, ability to continue to invest on our business, and we have no plans at the moment where we would need to raise any further capital before we reach our target break even, then profits.
I'm often asked, what is the sort of number that excites you in the results? And actually the answer is the 161,000 loss in EBITDA. Because one thing we have to do, and I think we notice it more than the most, is there are so many companies today that have extraordinary valuation and yet they have not profitable and not cash generative. We have to show in this model that we are a cash generative, profitable business. And that has always been our target from the very get-go. And what I'm very, very encouraged about is we look at this growth rate, we look at the headwinds that we're facing today, and we can get ourselves to this point of almost break even. You've got to think that when the headwinds change to tailwinds, and we see the regulatory benefits of MiFID II, and we see a more normal market condition, that will push us towards to profitability and our goal, and that and creating the value and the long-term value for shareholders. So I think for me, it's watching those losses decline at the rate that they are declining and watching the revenue growth makes me very, very encouraged for the future. The progress on the exchange division, I think we've gone through some of that. We've seen our liquidity rise, we've seen the number of members rise, we've seen our market share rise. One of the things that has been important is the new products. And there's two things that we've really done in the last 6 months. The first is, and I'm sure many of you will not have come across this thing called RTS 27. Well, in MiFID, what actually happened is that the regulation now requires every venue that 4 times a day, they have to state the spreads, the liquidity, etc. And that data is meant to be readily available on your website or publicly available to the marketplace. Well, as it happens, it's not readily available. It's certainly not standardized like it should be. But we have hired mathematicians to come in and take this data. And we've created a tool that actually looks at every single stock across the vast majority of venues in Europe and looked at this RTS 27, and you're more than welcome to go on our website. It's free. You have to sign up for it, and you're able to look at the data and the various tables. And what this is in effect, I think I may have mentioned last time how in sport, transparency has been forced on the sporting industry by making it fairer because you today have things like TMO or VAR or whatever it is. And here, this is for the first time, the first version of this in financial services. Because RTS 27, what we've done with this product is create the various heat maps. So you can look at a particular stock and say, on this date, on this time, who actually had the liquidity? And that's incredibly useful for a bank, or more importantly, an asset manager who has asked their bank to trade, who can now go round and suddenly say, well, I've noticed that on the 23rd of January or whatever it is in this particular stock, you gave my orders to X, but actually Y, or often in the case Aquis, has much more liquidity. And for the first time, you've actually got a tool which you can turn around to people and say, well, why did you do that? You know, this is now public information. And of course, that plays absolutely into our hands. And of course, this is why we've built this product, because it shows people about whether they are or not achieving best execution. So RTS27 as an analytics tool is something that we are going to use a lot going forward from here. And we think we're in a position where we can start a more of a name and shame strategy. I think at a time when you have a fifth of all the liquidity available at the best price, you're hitting 5% market share, we should probably be talking to the asset management community more about the people who aren't members, who don't access Aquis, and start looking and questioning, you know, why are these people and how are these people managing to achieve best execution? Because ultimately, it's your money, it's the asset manager's money, it's the retail person's money, who the broker may not be doing and achieving what they should be doing under the rules. So again, it's going to be a little bit more force going from here. We think we're in a strong position of actually pushing people to say, it is now time you start taking best execution very seriously. The second thing, and we mentioned it very briefly, I think last time, was the market at close and the auctions on demand. These are still in their infancy. We now have a couple of clients who are signed up to MAC, and we're starting to use MAC, which is the market at close product. Extraordinary, over the last year, we have seen an increase in the use of closing auctions on the national exchanges, whereby today around 25%, a quarter of all trading, is actually done in the close. Now, part of that, I believe, is down to the fact that there is illiquidity during the day because there are extraordinary economic circumstances which is preventing people from trading. But also there is this pressure that people want to go where there is liquidity. And remember what I said last time is that many of the exchanges in Europe charge a premium for the close, and it's a monopoly product. Now, you know what our views are towards monopolies, and monopolies are there to be broken because monopolistic pricing actually is not beneficial to the end investor. And hence why we've introduced MAC. And I would say that we've got these are early days, but very, very encouraging signs, because what we can do is for a much, much cheaper price, and this really is on this product alone, it's much more about saving exchange fees. We can get people a much, much cheaper method of getting the same closing price as you see on the national market. And that's very important. People don't want to have a separate closing price. There's one closing price for BP, not 4 or 5 on different exchanges, but you want to have access to it at a much cheaper price than you get elsewhere. So this is breaking the monopoly of the national exchanges. As I said before, we're Brexit prepared. And as I said, all is going very well, we think, on the exchange business today. Pass over now to the software business.
So I mentioned a little while ago some of our clients and the types of products that they're in. We have 3 products. So we offer a matching engine, we offer a surveillance system, and then we have our Aquis Market Gateway. And in reverse order, the Aquis Market Gateway is a facility where other venues can trade. So these are systematic internalizers who are able to trade bilaterally with banks and brokers. And that has proved to be a very successful and popular product. Market surveillance is a requirement, and you will find that people find the requirement in terms of the algos and the logic and then the alerting systems to be very complicated. We have a fantastic product for Aquis, and therefore it has proved attractive for other banks, brokers or exchanges to look at our market surveillance product. But probably the one which is most important is the exchange and exchange solutions. When you launch an exchange, the technology is core to that business. It's fundamentally important that you have a high quality matching engine which supports what you're trying to do if you happen to be in reinsurance or in bonds or even equities. And we have a client in South Africa who is a competitor to the Johannesburg Stock Exchange, and their matching engine and all their technology is provided by Aquis. So a very, very exciting opportunity for us, and it gives great future growth opportunities as we look expansion either other asset classes outside of equities or geographically.
Market data, one of our favorite topics, because in this industry, I think we all know the incredible price that people pay for market data and the amount of money that national exchanges make out of market data. But what most people don't know was that hidden in MiFID II, there is a RTS which says that if the industry doesn't provide a solution within 2 years, the regulator has the power to mandate a consolidated tape and look at market data. And that has started to happen. ESMA, the European regulator, has just asked for evidence and has got information as of 2 weeks ago, last Friday. You know, we sent our report back in. They've gone to the whole industry to ask for opinions of market data. We are very much in favour of creating a consolidated tape of record, which means a post-trade tape, not a pre-trade tape. That means not live prices, but prices the moment something's traded, as a starting point. Now, if that happens, there is this option within Aquis, in effect, that today we charge 13 vendors £2,000 a month to distribute our data. But of course, if we have a consolidated tape authority, you've got to look, how does this actually operate? And the way that it works in the US is that data price is set. And by the way, it is multiple times cheaper than it is within Europe. It is collected and mandated that all exchanges have to give their data to the Consolidated Tape Authority. They distribute that data. They charge the set price, the mandated price for that data. They take their costs out and distribute that revenue back to the exchanges, depending on the market share that they have. Now, I don't want to go through, certainly here on record, how to calculate what we think would happen within Europe. But the numbers associated with data have varied, anything from the entire data services being around €1 billion in Europe, down to what the national exchanges actually say, and they've written this out in a fairly recent report saying market data is actually only around 100 million. Either way, if you look at the revenues and you look on cutting those revenues substantially, and we have a consolidated tape, the revenue stream potential for Aquis is something that has to be considered by an investor, which we don't believe is being accounted for. I think within the analyst report in Librum, they talk around, I think it's £2 million, something like that, in a few years' time from that. I would really look very carefully on what you think that number can be in the future. There is an enormous opportunity, and I'd watch very, very carefully as to how and if the consolidated tape actually takes place. Now, there's absolutely no certainty that we will see a consolidated tape, but we think the view of most of the people of the reports that sent into ESMA are definitely in favour. And we also know that there's another study going on with the European Commission that is looking at this, and we also see there that there is very much an opinion that they would like to see some form of consolidated tape. A consolidated tape in Europe would be very, very advantageous for Aquis. And of course, onto the topic that I think many of you want to discuss today, because obviously it affects the retail market a great deal, which is our acquisition, or the proposed acquisition, of NEX Exchange. We've obviously are looking to acquire NEX. We are currently waiting a change of control authorization from the FCA. We are very optimistic about that, and we believe that, as I said, I think will happen towards the end of this year, so end of October, November time, something like that. Why have we bought NEX, and what is the purpose behind it? Well, I can tell you now that in my view, or certainly in our view, we think the market structure is broken in the IPOs market, in the listings market, particularly for growth companies. And we think it is time to see change in that industry. What you are seeing, and there's a number of academic reports out on listings, is a gradual decline for 30 years in the UK listings business. And one of the real issues that we have is that primary does not really allow retail investors to come in unless you have a full prospectus. And even with this new EU growth prospectus, it still makes it really expensive for a growth company to come to the market and allow retail. And I can tell you from the Aquis experience, we had wonderful investors, real blue chip investors come into Aquis. But blue chip investors, institutions, when they invest, tend to want to believe in the story for the long term. And if they believe in the story for the long term, it means they don't sell. If they don't sell, then guess what? You get great investors, but you get no liquidity. If you don't have any liquidity, then actually that prevents other investors from coming in who want to see that liquidity profile. And one of the things that we've learned over the last year is how critical the retail investor is to the whole IPO process. And we have to find ways that we can actually get retail in. Now today, if you look at what I would say the broken market is, if retail can't actually come into the IPOs because there is only an admissions document and therefore not a full prospectus, the only way that the retail investor can come in is on the secondary trading. And when they come in as secondary trading, we see that there's very little liquidity and very wide spreads. So the first thing that Aquis wants to look at is a way of which we can change this market in secondary trading. And we think we can do that because as somebody who has created this incredible deep liquidity by using innovation in rules, this proprietary trading rule, and using some very advanced technology, in other words, the auction processes and the technology we use for large caps and mid caps, we must be able to design a market with the market that allows for greater liquidity in the trading of small caps. Now, I believe that will, and we have a study today, and we are working with the industry as a whole, of using a technology that will combine quote-driven with traditional market makers, which are essential, because without them, you don't have the core bid and offer spreads, but also a hybrid market that has order-driven, so that people who really do have an interest in trading are able to come and trade and show the price. So today, if you see a stock trading 45 to 50, which is very common in small caps, so you've got a 10% spread, somebody who wants to come in and pay 47 can't actually declare that to the marketplace. So the person who comes in and wishes to sell, sells to somebody at 45 who promptly goes back and sells their stock to the person bidding 47. That means the seller misses out, the person buying at 47 misses out, and actually the issuer misses out because you haven't got the liquidity, because quite often that trade just won't take place. Now, we think we can find mechanisms to enhance that, and one of them will also be auctions. We cannot understand if we can operate an auction in 50 milliseconds today for large caps. Why can't we offer auctions that could be 50 minutes or longer in small caps so that we can actually find the point of equilibrium between buyer and seller? And that creates greater transparency, something which is within the ethos of Aquis, because the transparency will be what the real price of that stock is. And I think, given what happened with, regrettably in the industry, between what happened with Woodford funds and actually seeing the lack of liquidity that we see in the small caps, this is something that I think the regulator is going to look at very, very carefully. What are the real prices and tradable prices of small cap stocks? And if we can work with the retail, the wholesale, the market makers, and the new market makers by creating this hybrid, I think we can help change the liquidity profile. We can't necessarily guarantee huge liquidity in these stocks, but we have to be able to improve it from the current status quo. There's a series of other things that we're interested in doing. I'm not going to reveal everything today, but we are going around and talking to the very large number of the small cap corporate brokers in looking at ways in which we can enhance this market. And I don't think I've ever seen in any industry an opportunity that is as ripe as today for people to want change. There is an economic issue which is holding back stocks coming to market. We can't change that. That is cyclical. But there is a structural issue that is clearly preventing a lot of business from being done. And we can do that. And on a very interesting study done by New Financial, which is a think tank called The Purpose of Stock Exchanges. The conclusion on that paper, which is available on the internet, is lack of education in the IPO market, a lack of technology, a lack of innovation, and a lack of competition. And I look at the four things that drive us as a company and think what we've done in secondary trading can definitely be used in the primary markets to enhance the primary market and actually get more companies to come and list in the public space. What we are seeing today, tragically, is a de-equitization of the industry. More companies now stay private longer or get sold to private equity, or they get sold directly to large companies, technical companies like Google or Facebook or whatever. And you look at that and say the retail investor and the pension funds are missing out on the great growth companies that Britain has produced at the expense of all these private markets that are taking place. That is a tragedy, and if that continues, it is completely and utterly wrong. I think government needs to look at this, Treasury needs to look at this, and regulators need to look at this. And we certainly want to be part of that disruption to make certain that there is a move back from private equity into the public market space. That's probably a very good time to open up for questions.
You've told us a lot about the reasons why your business should be growing, why customers should be coming to you. Why aren't they more than they are? What's stopping them? What's getting in the way?
It's a great question, because actually what this is that during the cases, let's take a broker, a mid-tier broker, which is what our next target is now, having got 15 out of the top 16 banks now trading. So you take that broker, they have to have a presence in Europe. They have probably 6 relationships. They probably don't have a huge amount of staff in their operations and in their legal teams. They are completely swamped. And the choice they have today is, can I comply by my current regulatory standards? Because I'm not in a position to do Brexit, which is a bigger problem for them, because that's where they potentially could get fined and they could lose their business. Or do I join Aquis? And as much as I think we can embarrass them and say, you're not a member of Aquis, therefore you'll lose some of your customer business, that is actually not as bad as we're going to be closed down because we're not ready for Brexit. So I think the entire mitigation that we put for the growth of customers is the fact that these people are focused on too many other things right now. And I think that malaise shows in the turnover there is in the market and the lack of IPOs and everything else that's going on right now. It's market circumstance. So I think this is cyclical. This is not the part that's broken. I think the market's broken, and I think we can fix that part. But that is the reason why we're not seeing members. Our sales funnel going forward from here is very encouraging. And we know a number of people that are telling us they're signing up, but they can't even get the regulatory paperwork done yet, because the lawyers is just, they've got all these different things they have to do.
So you want Brexit to finish one way?
I'm not alone in the many, many, many millions of people sitting in Britain today and across Europe who have got Brexit fatigue and are watching their business suffer as a result. In our case, not suffer through losses or whatever, but suffering because our growth could be substantially higher. And I'm absolutely convinced that our growth is not as great as it is, and it's pretty good growth today, but Brexit is holding that good growth back from being even better.
If you keep growing, what are or will your competitors do to say we can't allow this, we're going to have to...
Well, they've started to, and I'm encouraged, because actually that's the greatest move, is Turquoise has now altered its prices twice in the space of 6 months in order to try and capture market share. Now, the Turquoise continuous book, or the lit book, used to be much, much bigger than us. We are now, as I look today, pretty much closing on being twice their size. So they've seen a substantial decline while we've seen a substantial increase. And in return, what they're trying to do is now attract more liquidity providers by increasing the rebate on a maker-taker model. And I quite like that, because it tells me, in our days at Chi-X and when we were at Chi-X, we never changed our price once. And we found that to be an incredibly strong thing, is people knew where they were, they knew the model worked, and actually, now, That's a good sign. Now, in the subscription models, you tend to start low, and subscriptions do go up in price. I think the industry recognizes that, but you do that from a position of strength, not a position of weakness. Changing price at a position of weakness, I think, is a really dangerous thing to do.
Can I ask a little bit about, you've got 14 out of the 29 leading investment banks.
Yep.
How many of those are I think last time you talked about the different volume, price levels. Are they all at the 50 grand a month?
No, absolutely not. When we floated, we said we had one that was floating in and out of the 50 level. We don't declare how many, but what we do say now is we have a number of them in there. And quite amazingly so, just to show the model does work and how it works. It's a bit ironic, but we had one of those companies that hit into the 50,000. They called us up and they said to our traders or our sales desk, we've just noticed we can carry on trading now and it doesn't cost us anything. So after 5 years, well done, we've been talking about this. They said, well, we should change our smart order router now, that whenever you are available at the best price, we should come and trade with you. And he's like, yes, it's amazing. And it just goes to show that people don't do what they are explained until they actually have that proof in their hands. This customer went
Something sounds too good to believe. You don't believe.
And I think that's right. But what happened? That customer went from trading 30,000 messages a day, which is the threshold to get into the 50,000. They trade now north of 60,000 messages a day. That is, an incredible move, and it just shows and proves the model. And it's the same thing as I do when my children use Spotify. I don't count how many, records or songs they listen to. Just use it. Carry on using it. Doesn't matter. You can listen to it 24 hours a day if you want it.
So my concern is, if you're turning over 3.5 million in the half year with 5% market share, so the market size, if you've got 100%, it's 20 times that. So it's 7 times 20 is, what is that, 140 million. That's your absolute potential.
No. Do you have Sky at home?
Yeah.
Do you pay for anything outside of standard Sky?
Sport, yeah.
There'll always be premium products. And you'll introduce. So if you think of your market size here, 15 banks will pay you 50,000 a month. That gives you your 9 million a year. Something like that. You've got another 65 odd clients that you want to trade with you. You think that's what the opportunity is, probably 90 odd potential clients around Europe who would use this type of system. You think you can get them to the 15, 20,000 average, whatever it is. You've got to get another 9 million probably from there. So you're at the 18 million just from your exchange business. Well, what is the price elasticity when you're there? Because you're already many, many times cheaper than your competition at that point. So say you increase your price, you're already now at the 18 million, say 25 million on that. What about your premium products on top of it? What about then your exchange technology business? And how much are you going to make out of that? What about data when it comes in? And of course, the monetization of NEX actually is nothing to do with listing fees. It is all to do about creating the important growth market. And it's the value of that data in the stocks in the growth market. It's the value of the indexation of that, and it's the value of the turnover in that on the trading of those stocks. That is what turns you into being the exchange services group that we desire. And your upside is much, much larger than looking at it just saying, because you're not going to capture 100% of the market. No. The reality is you're probably going to capture, historically, and looking at the US and looking at other companies here, where I was before at Chi-X, you get to around the 20% mark, and the market self-regulates. Now, I believe, the subscription model is more powerful than that, but I think our upside opportunities do not look at it as a subscription model that caps the upside, because Amazon Prime doesn't cap it, Spotify doesn't cap. There's always additional product. If you have a mobile phone and you want to use more data, they'll charge you £5 a month extra for it. If you have, Netflix and you actually want to put another user on it, there's another $5 a month for it. There's always a premium product, as long as we're moving forward and being innovative, that actually increases the value of your.
What about your sort of management bandwidth? Because obviously a small company, you've got a lot going on. You've still got a lot of clients to capture in your exchange business. Are you going to be distracted by NEX?
I don't think so. We were very distracted by Brexit, and we think the Brexit planning is over. So, we've done what we needed to do. We think we have the resources. We are hiring additional resources in there. As Jonathan said, we saw a 21% increase in costs. We'll make absolutely certain our costs are going to be nothing like the increases we see in revenues, but we will invest. It is very, very important.
But is
to
it
invest.
you that goes and sees these 90 clients that you're after?
Well, I will see the 20 clients or so that I think are critical to us at this point in time, and it's me who's gone to see the last, the 20 odd brokers that we've gone to see. But we're hiring somebody right now. In fact, we're hiring several people right now. At this point in time, it's sort of I need to meet their CEO, and they want to come and talk to me about what the plans are going forward and how we monetize that. You've got to have an expert in that field. So yes, we're well aware, I think, of the bandwidth and how important it is not to overstretch management. But on the other side, I think we are very comfortable within where we're going right now and what we have right now to be able to build this business.
I'm curious, the 5% threshold will cause, I think, a number of people to be forced to evaluate you, as I'm assuming ultimately for potential inclusion into your algorithm. I'm just wondering, in terms of these participants, whether these are the types of market participants that could eventually grow into a top tier customer?
So most of the people who we look at the next growth rate from are what I would call the mid-sized investment banking and broking community. Those who are, when you talk about the sort of the model of, they will follow when other people have done this. And I think because we've got to the level now, that's where the real growth in membership comes. And so they're not the people we're talking about, the 15 or so that will pay the 50,000 a month. They are part of that 65 group that we're going to try and get to somewhere between the 10, 15, 20,000 pound level. But they're still key because their flow is important. And we need to show that growth, that it's not just coming from those specific big banks.
Lovely. Thank you very much.
Well, no, thank you all very much. And thank you very much for all the support you've given us, because it's nice to have great supporters.